You've probably seen the headlines floating around lately. Executive Order 2026, Strategic Metals, Government Control. Some channels are openly asking whether silver ownership could be restricted, regulated, or even seized. Others are framing this as a certainty, a deadline, or a countdown clock. Today, I want to take a step back and slow this conversation down. Not dismiss it, not amplify it, but examine it carefully. What's actually being discussed in policy circles, what the historical precedents are, and what the probabilities really look like. This is Financial Briefing, and the goal here is clarity over clicks. Before we go any further, I want to remind you how we approach these topics. Earlier this year, we said there was roughly a 55% chance that silver would consolidate between $28 and $32 before making its next directional move. That range held for almost 4 months. Last year, we argued that fears of immediate gold confiscation tied to CBDCs were overstated, assigning less than a 10% probability, and so far that's proven accurate. We also expected increased government interest in critical minerals as a policy theme, not a panic event, and that trend has continued quietly rather than explosively. Those calls weren't perfect, but they were grounded in probabilities, not narratives. So let's get into the data that's driving this conversation. The first data point is silver's role in strategic industries. Roughly 55 to 60% of annual silver demand now comes from industrial uses. Solar panels alone account for about 15% of global demand, and that number has doubled over the past decade. In the 1990s, industrial demand was closer to 35%. What this means is that silver has shifted from being primarily a monetary and jewelry metal to a hybrid industrial input. What it does not mean is that governments automatically gain the authority or incentive to restrict private ownership. Strategic importance does not equal confiscation. The second data point is domestic supply vulnerability. The United States produces only about 1,000 metric tons of silver per year, while consuming closer to 5,000 metric tons. That gap is filled through imports, primarily from Mexico, Canada, and Peru. Historically, this is not new. The U.S. has been a net importer of silver for most of the last century. What this means is that supply chains matter, especially during geopolitical stress. What it doesn't mean is that restricting retail ownership meaningfully solves that problem. Coins and bars held by individuals are not feeding semiconductor fabs or solar factories. The third data point is legal precedent. The most commonly cited example is Executive Order 6102 in 1933, which restricted gold ownership. Silver was explicitly excluded. Even during wartime mobilization in the 1940s, silver ownership remained legal, with the government choosing to buy silver at fixed prices rather than seize it. What this means is that even in periods of extreme national stress, policymakers have historically favored price controls and procurement over outright bans. What it doesn't mean is that it can't happen again, but it does mean the bar is very high. Now let's talk about the bullish case, meaning the scenario where concerns about restrictions gain traction. First, if silver is formally designated as a strategic or critical material under expanded national security frameworks, reporting and export controls could increase. Second, if industrial shortages become severe, governments could prioritize supply through incentives or temporary restrictions on large-scale exports. Third, if monetary instability accelerates and silver begins functioning as a parallel monetary asset, again, regulatory scrutiny could increase. Fourth, coordination between industrial policy and defense policy could blur traditional lines. Taken together, I assign about a 25% probability to a future where silver ownership becomes more regulated, especially at institutional or commercial scale, but not outright banned. Now the bear case, which is equally important. First, silver markets are globally interconnected. Any unilateral restriction would be difficult to enforce and easy to arbitrage. Second, politically, restricting ownership of a widely held metal with deep industrial uses creates more backlash than benefit. Third, governments already have more effective tools, such as strategic stockpiles, long-term supply contracts, and subsidies, to secure silver supply without touching private ownership. Fourth, silver lacks the monetary centrality that gold had in the 1930s. For these reasons, I assign a 35% probability that this entire narrative fades as policy discussions remain technical and boring rather than dramatic. That leaves the middle case, which is where I think reality lands. In this scenario, silver is increasingly treated as a strategic input, but ownership remains legal and unrestricted for individuals. Reporting requirements may expand for large transactions. Industrial users may receive preferential access during shortages. Investors see more volatility, not less access. This is not confiscation, but it is politicization. I put about a 40% probability on this outcome. To understand why this matters, we need historical context. People often jump straight to 1933, but that was a very specific moment. The U.S. was on a gold standard. Deflation was crushing the banking system. Gold ownership directly constrained monetary policy, none of ownership. Those conditions exist today. A more relevant comparison might be the Defense Production Act era, where materials like steel, copper, and rare earths were prioritized without banning. The similarity is strategic concern. The difference is monetary role. Silver today is not the backbone of the financial system. Now let's zoom out to cross-market signals. Gold has been holding above $2,200, telling us there's ongoing concern about monetary stability, but not panic. Silver, trading around $31 to $34, is outperforming on industrial optimism, not fear. The dollar index remains range-bound near 103, signaling no loss of confidence in the currency. The 10-year Treasury yield around 4.3% suggests restrictive policy, but not emergency conditions. Together, these markets are not pricing confiscation risk. Positioning data reinforces that. Commitment of traders reports show commercial hedgers reducing short exposure in silver, while speculators are long but not extreme. Banks are increasing exposure to physical supply chains, not derivatives. Institutional investors are adding silver for diversification, not protection from government action. This is positioning for demand growth, not confiscation. So what am I personally doing? Here's my framework. If silver is formally designated as a strategic asset with ownership restrictions, I would reduce exposure to paper instruments and increase allocation to allocated physical holdings. If regulation remains limited to reporting and industrial prioritization, I maintain current positions. Right now, my allocation is about 30% precious metals, with silver making up roughly 12% of the total portfolio. My stop loss on silver-related equities is around 15%. My take-profit levels are staggered at $38 and $45 on spot silver, depending on macro conditions. This is not advice, just my framework. What I'm not doing is panic buying based on rumors. I'm not assuming worst-case outcomes without legal text. And I'm not letting fear override probability. Here's what I'm watching this week. First, language coming out of industrial policy discussions, especially around critical materials lists. Second, silver lease rates, which would spike if physical supply stress becomes acute. Third, legislative signals around reporting thresholds for commodities. Bullish signals would be rising lease rates and supportive language without restrictions. Bearish signals would be silence and normalization. Let's wrap this up. The idea that the government could restrict silver ownership is not impossible, but it's also not imminent or inevitable. Strategic interest does not automatically translate into seizure. The most likely outcome is increased attention, not loss of access. Stay grounded, stay data-driven, and don't outsource your thinking to headlines. If this kind of calm analysis is useful to you, consider subscribing. This is Financial Briefing. Stay sharp.